around our natural capital. And as we said, there is a real overlap between the conversation on renewable energy and the conversation around natural capital. And for that, I'll invite Dr. Susan Chomba to come in and lead us in a conversation about that aspect of the distinctive Kenyan story.
Thank you, James. Ladies and gentlemen, the panel that you've all been waiting for is finally here. So this panel on natural capital will focus on innovative and transformative models for public-private finance and natural capital in Kenya. As you've heard, Kenya is a biodiversity hotspot, also a tourism hotspot, and a country endowed with immense natural capital, which is the foundation for a thriving economy. Despite these critical roles, Kenya's natural capital is on the decline under immense pressure from different drivers. To reverse this trend and rebuild our natural capital into one that can accelerate green and resilient growth, investment in transformative models of finance is critical. But even more critical is the need to ensure that these models prioritize social and governance dimensions such as equity. To help us navigate these issues, help me to welcome 4 key panelists: Honorable Mohamed Elmi from the Ministry of Environment, Sheila Agrawal Khan, Wanjiro Madai, and Giles Davis. And without further ado, I'd like to start with Giles Davis. Giles, you are the founder of Conservation Capital. We have all heard about Okavango Capital and its ambition to raise funds for conservation. What are the key challenges in raising private investment, and what would make funds like Okavango more attractive for private investors? Giles, over to you.
Thanks, Susan. Okavango is a very exciting and specific opportunity, but if I may, I'll speak a bit more generally. I think the good news is that there doesn't appear to be a problem with investment appetite. He was referenced earlier on, but you have people like Larry Fink, the CEO of the world's largest money manager, BlackRock, talking about a tectonic shift towards sustainable investment and a wall of capital building up to fuel it. But why are we not seeing that yet manifest itself meaningfully on the ground, at least on the frontiers of biodiversity conservation, which we tend to operate in? And I think to answer that question, you need to look at both the supply and demand sides of that equation. Firstly, you have an issue of scale. On the demand side, history has tended to show, I think, that good conservation happens locally, and hence on the whole, it tends to happen small. But capital markets don't like small, they like big, mainly because they need to amortize transaction costs and risk. And I think there needs to be a bit of a meeting in the middle here. So on that supply side, capital markets need to learn how to create and organize what I think is a greater number of smaller capitalized investment financing vehicles than they're perhaps used to. You know, at Conservation Capital, we're constantly doing feasibility studies and have launched a few of these. And we see so much scope for vehicles in, say, the $10 to $15 million range. But the constant refrain is that sounds great, guys. Is there any way you can make that 100 and 150 million, or even more, in fact? So that's a challenge. But on the demand side, that needs to evolve as well, Susan. You know, conservation managers do need to learn how to aggregate product better. And there's so much scope for this to be done, that there are so many wheels being invented or reinvented across different conservation projects and initiatives. And the scope for consolidation, collaboration, and aggregation is enormous. You see this in organizations like Northern Rangers Trust on the operational side, and I don't see why that can't be done in the development of financial products too. I think the second big issue is risk. Transformational projects tend to have a higher risk profiles as people try to do new things. We've heard many of them on the panels today, to break the many glass ceilings that sort of kind of exist in the natural capital conservation space. But again, capital markets tend to be quite risk averse. Aggregation, as we've already discussed, is one way of mitigating risk because you bring portfolio theory into play. But there's much more that can be done here, I think. And for me, one major opportunity lies in creating better partnerships between the traditional financiers of conservation, say public money and philanthropy, and this emerging commercial impact-driven finance. I think there are two main areas here. The first is using grant capital in blended structures to leverage and de-risk commercial capital through things like first loss or guarantee-like mechanisms, and we've had that discussed already today. So secondly, by providing more and better focused technical assistance funding around the private investment vehicles to support not only the strengthening of their commercial credentials, but their impact ones too. Just one final thing, I know I'm going to run out of time, but on the subject of risk, investors, and Steve, who you spoke very early on, will be very alive to this. Investors need to start thinking about natural capital investment, not only in terms of upside and return, but also avoided downside. That was a huge theme of Mr. Dasgupta's recent review. And I think once there's a better understanding about this, I think you're going to see much more capital start to flow. But ultimately, Susan, that's a wider market education point.
Brilliant. Thank you so much, Giles. And over to you, Sheila. Sheila, you are the director for GCF Coordination Unit at IUCN. Just building on what Giles has briefed us on, getting private capital into resilience projects is obviously not a walk in the park, since resilience projects do not tend to generate quick financial returns. What's the GCF doing to crowd private investment into resilience projects, Sheila?
Thanks, Susan. So, in fact, it's exactly as Giles says, there's a big challenge here. And one of the things that both the Global Environment Facility and the Green Climate Fund are doing is trying to bring a mix of different funding instruments. So not just, of course, the usual or what would have been there in the past in grant financing, but looking at debt and equity and guarantee instruments to be able to support some of this work. Of course, it's not that it comes just, easy, you can just put it in and you get, some debt financing. As Giles knows, we've had some challenges with some of the initiatives to try to get them off the ground, because they also want to see the investment that is able to come in from the private sector, and then they're willing to come in with a first loss position. I'll give you an example. We recently had approved with Green Climate Fund financing a subnational climate fund program, of which Kenya is now a part of, and it received 150 million in equity financing from the Green Climate Fund, but the fund is going to mobilize a total of 900 million from private investors and other players for lots of initiatives that are already coming through into a pipeline on renewable energy, but also on nature-based solutions. So the challenge, of course, with the portfolio on nature-based solutions is it doesn't have that kind of level of investment that has been seen in the renewable energy space, but it is a really growing market that's coming through. You might know about the Kenya Twende project, which is also recently being launched in Kenya. In fact, now as we speak, with the support of the government and particularly the Treasury Department. So Peter Adengo has been a big player and the rest of the government on this. And part of that initiative is actually to help seed fund a set of pipeline deals. And as Giles says, these will be small scale, but they will be aggregated into a portfolio which could then receive investment funding. And it's in an arid, semi-arid landscape in which this initiative will work. So some of these pieces of work are coming together. But maybe I'll let you go on to the next speaker, and I could come back later and talk about some of the other initiatives where we're trying to seed fund some of the work to be able to develop the pipeline, because that's the key challenge we see is sometimes you have investors willing to invest, but they're looking for an interesting pipeline, and we have some interesting initiatives that are trying to do that. Thank you.
Brilliant. Thank you so much, Sheila. And definitely we're going to come back to those kind of very forward-looking, in terms of what's happening in seed funding. But I'd like now to move to Wanjera Mathai. And, Wanjera, you are the Vice President and Regional Director of for Africa at World Resources Institute. And we also understand that World Resources Institute previously has set up an investor forum. So would like to hear more about this investor forum. What's the experience with the investor forum? What kind of investors were engaged, and what kind of wisdom would you like to share from the experiences with that investor forum? Wanjera.
Thanks, Susan. Well, you're right. One of these forums that WRI set up is the Land Accelerator. And even before I talk about it, I think both Sheila and Giles have touched on exactly this missing middle that is the big challenge for all of these forums that investors are looking at. So we've hosted a couple of cohorts, one in 2018, another in 2019. And when WRI created the Land Accelerator, it was really about training and supporting entrepreneurs who wanted to start companies or who were running companies already, restoring degraded land. So this platform is essentially giving training and skills building in both business development and environmental management. It is really exciting because what it does is in many ways creates this landscape of entrepreneurs, a network of entrepreneurs who together go through this week-long workshop, and then of course ongoing mentorship, around 4 months of it. But here's the thing, the world over, companies with a wide range of business models have been making money from planting trees and transforming agriculture, as we heard even before. But these businesses are proving that, and these businesses actually are proving that restoration of degraded forests and agricultural land is not only good for the planet, but it's also good business. And that opportunity is there. And to Giles' point, it has both the upsides and also looks at avoiding the downsides. But the opportunity is just not fully optimized. And in many ways, sometimes when I'm talking about this, I talk about it as a mental leapfrogging. There's something that's just not connecting. And that's where the Land Accelerator actually came in, because it brings together investors into a forum with these business owners and entrepreneurs, and begins to build a relationship where they learn both the language that investors use, but also what it takes to pitch and to present winning investment opportunities and investment portfolios. What we are finding is, first of all, that there are thousands of inspiring restoration entrepreneurs out there. You will not believe, over 1,600 applications come in from around the globe for these opportunities. And then, of course, our alumni from the program report creating thousands of jobs. Some in Africa who said they're working with 150,000 farmers, and then, of course, working and restoring 100,000 hectares of land. So there are real gains, but there are real challenges. And in some ways, Giles preceded me because he mentioned exactly some of the main ones. Lending for restoration, for example, for restoration businesses, there is a time frame issue. The time frame for loans just doesn't match the time frame for revenue growth. All of us know that for many, tree-based solutions require what? 10 to 30 years for sustainable timber to mature, and that's in the tropics. Any other timber products, if you're looking at seeds and leaves and bark and nuts, would produce only about after 3 to 5 years. So traditional loans just don't cut it, and the immediate payback that they require is just not an option. So again, patient capital is required. There's also another barrier that is around the focus on traditional commodity supply chains, coffee, tea, some of those staples that most people are familiar with. And oftentimes, people who are in landscape restoration, these entrepreneurs are working with what would be considered new crops. So bringing in, diversifying farm crops and other new trees. And these examples are just too risky for a lot of investors. They're not familiar with them, and so they're not even willing to invest in them. Another issue that we've found is traditional equity investors, I would say, don't find potential repayment enough to incentivize investment. They want to invest in technology. They want to see heavy, solar panels, irrigation solutions. And some of these restoration opportunities are not yet as tangible for them. So, I mean, Giles, you mentioned restoration businesses need blended finance. I would say perhaps one of the biggest opportunities, but also one of the things that is a huge challenge, is this missing middle. A lot of what we are doing, at least at WRI, is looking at, can we work with others to see how and when we can help replicate the success in investing in this field by creating a fund like the Rural Prosperity Bond, which would actively explore partnerships that create revolving loan funds that will finance land restoration companies that are currently unfunded, and largely because they're in this missing middle that we're saying, too big for microfinance institutions and yet too large and not large enough for international climate funds. And so that around $1 to $5 million. So that would be, for me, one of the biggest opportunities in this sector. But that's what we're finding, Susan.
Oh, thank you so much. Thank you so much, Wanjera. Brilliant. And now just coming back to Honorable Mohammed Elmi, because we understand the policy environment is also critical for this kind of investments. And we are really pleased to have you, Mohammed. You are the Chief Administrative Secretary at the Ministry of Environment and Forestry. And building on what P.S. Muya said in the morning, as well as Peter Odengo, in terms of really creating an enabling policy environment for natural capital investments, what would you like in summary? And I know this is probably a lot to ask in a few minutes. But Honorable Elmi, in summary, what would you tell us that the government is currently doing to incentivize investments in natural capital?
Thank you very much. And sorry that a few things went wrong and I'm coming in late. I'm sure Peter Odongo probably would have talked about it. The government is doing, and I'm told it is on the final stages, the green fiscal incentive policy. And it's in its final stages. And but at the same time, there are a lot of enabling legislation in tourism, in Kenya Forest Service, that are already helping private sector finance some of the things. Somebody mentioned NRT, which I was the chair until last week. And you could see tourism, communities making money out of tourism, where then they pay for school fees, health, and a few other things. And you could see a number of those things are being enabled by, let's say, the Wildlife Act in terms of taking care of the range. At the moment, they are also trying to do, let's say, the grass, carbon from grass, and they've been working on it for a long time. But I just wanted to say that while the policy is on way, there are a variety of things that are being done. The next, you asked that the next bond, green bond, I'm reliably informed that 80% of it will go to natural capital, largely around, small water irrigation, small water harvesting, and forests, which are the areas that are not currently well funded. So out of 100 billion, if 80% will be going to natural capital, that will be a great thing. The other thing is the long-term, resilience building that is going to be up to the world base. That's about to kick off also. But I just thought I would probably add a few things that we haven't tried. We know that the biggest part of our natural capital, the land, is in the north and the arid, and quite a bit of it is degraded, and we do have a desert. Yet renewables like grass or forests are not being, we're not making use of that. And I was thinking, while we're looking for these big investors, we could think about the cooperatives, well, so that the small people can pull together and do long-term investment. If you took a big chunk of Gajalbe Desert, there, Kefi will tell you there are trees that will grow there, and they will make money, as what do you call, somebody else has said just now. And then the other area we have not checked is the pension funds. They invest in all sorts of things which are risky, and if we're looking for something that is beyond 10 years, probably some of the pension funds would do that. And the returns in some of the renewables are quite substantial in my view. And then linking that to livestock marketing, which is currently not well taken care of. So you can imagine if you restored the landscape with grass for both wildlife and livestock, and the livestock marketing was properly handled, then you could see livestock funding back the restoration of the grasslands. And that's what I would say for now. Thank you.
Thank you so much. Thank you so much, Honorable Elmi, for those interventions. I think they build very well on what Giles had mentioned about aggregation and risk reduction, as well as new investments in arid and semi-arid areas, as well as basically also what Wanjera and Sheila had also touched on. So thank you so much. I'd like now to turn back to Giles, and this perhaps also links very well with what Honorable Elmi just mentioned here, about really looking at it from also a community perspective. And Giles, I'm interested in knowing, how can we make sure that communities are not just getting the short end of the stick when private investment in conservation happens? For example, that we are not just talking about low-paying jobs, but we are talking about real benefit sharing mechanisms that are fair and equitable. Are there models you'd like to quickly share with us that can demonstrate that that's possible?
Yeah, I mean, it's a big point, big topic, Susan, but at a headline level, I think that there's a value chain allocation issue here. The conservation of natural capital needs to be sort of priced properly into the value chains that build off it. And tourism, which Mohammed mentioned, is a great, but it's not the only example. This applies as much to energy or food production as well. What relevance has that got to do with communities? Well, mainly because one of the principal roles that communities play is to act as stewards of natural capital. Look at how many community conservancies we've got building up in this country. It's brilliant. But is the tourism value chain, say, properly reflecting this underlying value? Not fully, we don't think. More of that value chain needs to be allocated to that stewardship. And we're currently in the middle of a deep dive assessment of this. And it comes largely down to the way in which conservation or community fees, which tend to function as revenue-based royalties, are structured, quantified, and accounted for. We think there's a much better way for this to be done. It's going to be better for communities, better for tourism investors, and better for conservation. But just to be clear, this isn't just a matter for the private sector. I think there's a policymaker issue here as well. Thankfully, I completely exclude Kenya from what I'm about to say because it's not an issue here, but there are too many countries on this continent that make it too difficult for communities to enter into meaningful roles with respect to ownership or even stewardship rights over natural resources. And as a result of that, it makes it very difficult for them to contract with the private sector at all. And that's something that needs to change in those countries concerned. Financiers, a big theme of today, also have a role, Susan. When you go to a bank and get a loan, the contract will be replete with financial covenants, giving the bank sort of defensive powers if you don't manage your underlying business with certain financial parameters. With the small investment funds that we've developed both here and in Europe, we've extended that into the environmental and social space using what we call conservation and social governance. And we use those, or use the latter, to drive better employment practices, more pervasive local purchasing, greater levels of diversity and inclusion, and where possible, more balanced ownership participation. And there's so much more scope for those kind of covenant tools to be used in the allocation of finance. There's also a lot of room for innovation here. I'll just pick up on that ownership thing. One of the things that we're currently working on, which plays again to that notion of the traditional grant givers in conservation and the more modern investment financiers coming together, is a grant capitalized fund. We don't often work with grants, but that would be used to buy out what we're calling nature stewardship bonds, specially structured stakes in existing going concern businesses on behalf of relevant local communities. It's a kind of a massively scalable concept. You can do it in any business anywhere in the world. And I think could create real benefits for target communities in terms of being able to plug into the immediate benefit flows of proven and hence de-risked businesses. Too much focus is on startups all the time. And there's so many great businesses that you could plug communities into. We think it's great for them. We think it's great for donors. We think it's great for the businesses, of course, for conservation. And if you start to reshape or remodel ownership using willing buyer, willing seller, market-based mechanisms, it's going to make so many of these businesses much more resilient. And then, of course, free the capacity for the more mainstream commercial investors to come in on the back of that. So you really, again, finance can play a role here, and you put together this sort of ecosystem of novel financing mechanisms. You're going to increase resilience, reduce risk, and you'll start to see more value flowing, which can be reorientated to the benefit of community stakeholders if you're clever about it. And there's so much scope, Susan.
Thank you so much. That's a very positive outlook. I'd love to know more about the nature stewardship bonds. That's evidently something that is, really looking forward to learn more about it. I'd like just to go back to Wanjera in 2 minutes, Wanjera. And again, I absolutely know it's not fair to ask people to summarize such, broad subjects within such a short time, but still I'd like to again focus on social safeguards because I come from a governance perspective. And so really thinking through about how we can make again investments in natural capital, not to exacerbate inequality gaps in society. And if you could also mention on how we can avoid the risk that we've always had about greenwashing. Kindly, Wanjera, share with us, in 2 minutes, some of your takeaway tips on avoiding exacerbating inequality gap and avoiding greenwashing kind of projects in natural capital investment.
Thanks, Susan. I really just build on what Giles has shared, because local leadership is a key part of that. But off the top, just to say that increased private investment in this sector is desperately needed, and we should encourage it as much as possible. There are a lot of opportunities for returns if we value them right, the underlying assets, of course, and also having a significant impact on communities and ecosystems. So that's off the top. I think that's an important point to make, because often we could be misunderstood to say that this is not needed. No, it is needed. But I want to start by saying it's fitting that we are celebrating Wangari Maathai Day today, Africa Environment Day, and World Wildlife Day. And if we learned anything from the genius of the Greenbelt movement, it was that investing in natural capital, especially in Africa, has to engage local communities and has to be locally led, because we're talking about investing for the long term, and this requires local ownership and local stewardship. So that's a really fundamental part of that, and how we make that happen will require activating financial pillars, and we've talked about that now. That is really important. So those natural capital investments have to consider those underlying socioeconomic impacts alongside the environmental impacts, of course. So as you are looking at all these different potential impacts, the socioeconomic are often left out. And this is something that, when it's added, will not only ensure an equitable disbursement of benefits across the different economic segments of society, but also ensure, again, the long-term sustainability of these projects. We've seen that happen, and we've also seen the potential risks of not doing it. So I would say those safeguards should be employed for all private investments in natural capital. And then there's also a need for transparency and consultation and the consent of local people. So often people misunderstand what community engagement and community consultation is. It's a real, genuine, heavy lifting. And I agree with Giles, and it has been done quite well in a lot of community conservancies, but also in some not so well. And so we really need to be fully inclusive.
Wanjera, sorry, in the interest of time, let's have, sorry, yeah, but we've taken key takeaway points there in terms of real community engagement there and applying the social safeguards. So Sheila, kindly, if you could summarize for us this session in terms of, with a forward-looking intervention, what opportunities of vehicles for different players and to engage in natural capital investment do you see in Kenya? Sheila.
Okay, thank you. I think there's a number of different avenues, and it depends on the lens you're coming in from. I mean, if I were to look at the whole issue of getting together a pipeline, and Wanjera stating that seed funding is a real issue, I think there are already quite a few programs coming through to be able to offer those seed funding, whether it's the WRI Land Accelerator program offering training. IUCN with Merova Bank has developed a Nature Plus accelerator program also to help with developing this pipeline for investment. We're also right now in discussions with the French government and some other governments about financing a forest landscape restoration hub, a nature-based solutions hub, which would basically help to seed fund pipeline deals. But then you could be coming in, for example, with access to loan financing, as KCB mentioned in the earlier session. There's scope for that, and there's scope for very innovative partnerships between, in fact, many of the players at this conference. We're right now exploring the concept of a resilience bond, which would connect insurance to crop and livestock insurance to climate resilience. And we're coming in with grant financing. I could just as well see KCB supporting this with something like looking at how they could secure Green Climate Fund financing in this space and partnering with us. So there's some very, you could seek for even Guarantco coming in with a guarantee so that it would reduce the, let's say, the risk for investors. So whether we're looking at value chains or whether we're looking at broader landscape restoration, or how to, let's say, provide more nature-based solutions to energy deals, there's a lot of scope for many different lenses to come together to be able to offer different payments, whether it's carbon payments and grasslands, as Honorable Elmi said, whether it's coming in with new ideas for the next green bond. I think some of these accelerator programs could be quite interesting to help seed fund that thinking.
Brilliant. Thank you so much, Sheila. Now, ladies and gentlemen, in the interest of time, we have to close this very insightful session. I wish to thank our panelists greatly. Thank you so much, Sheila, Honorable Elmi, Wanjera, and Giles. And back over to you, James. Thank you.